Bitcoin pumps, tulips bloom, and influencers are once again divided over what is good or bad for Bitcoin. We will get into all of that and more on today's episode of the Bitcoin Bulletin Podcast.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Guten Tag, Buenos Dias, Morian, and welcome to episode 213 of the Bitcoin Bulletin Podcast. You know, every time Bitcoin starts to pump or to run, it seems like some brand new hater, no-coiner, learns about the tulip mania, and they think they have just discovered the end-all, be-all gotcha that will just shut you up once and for all and prove how idiotic you are and how smart they really are. And we've already seen the tulip mania referenced once this cycle. Not as bad as in 2017, when it was really trendy to bring up the tulip mania the first time people heard about it, as if they had known about every aspect of the tulip mania their entire lives and were just waiting for Bitcoin to come along to spring it on their friends and family over a Thanksgiving meal. We're going to get into that here in just a second because I want to talk about a tweet thread, and Luke Broyles posted on Twitter 2 days ago about the economy, and it wasn't specifically about the tulip mania. It was about the collapse of global reserve currencies and global empires. And he wrote, "Everything is fine until everything collapses. The Dutch were the world's most powerful empire a few centuries ago, with the world's most powerful monopoly, navy, and trade routes. Everything was great until they demonetized their own spice trade. They were so effective they eroded the value of their balance sheet, had a feedback loop of cultural decline, and then the debt exploded. Debt can continue to be refinanced until suddenly there is no demand for the debt. Stocks can continue to expand valuations until there is no demand for sovereign debt. The Dutch made it for 300 years, then the whole thing fell apart. Stocks collapsed, yields skyrocketed, and spice became now affordable for everyone." And the tweet continues and he posts some charts. But what piqued my interest was Always Learning in the comment section replied, "At Luke Broyles, any connection to increasing money supply with tulip mania?" Well, that's an interesting question. So let's dive into that just a little bit. Tulip mania, well, it occurred roughly between 1633 and 1637. And it was a speculative bubble in the Dutch Republic where tulip bulb prices soared to extraordinary levels before crashing basically to nothing. Tulip bulbs at one point reached prices as high as 4,000 to 5,500 florins, and that was equivalent to multiple years' labor for even a skilled artisan at the time. It was driven by speculation, crowd psychology, and a fear of missing out. Sound familiar? But like all bubbles, it burst in 1637. So the question posed by Always Learning in the comments was, did the increasing money supply play a role in tulip mania? Well, in modern economic terms, an increase in money supply often refers to a central authority like the Federal Reserve, a central bank, expanding the amount of physical money in circulation, typically through measures like lowering interest rates or printing money, of course, or simply just easing credit conditions because, you know, in Keynesian terms, all new money is basically created by debt. So as Bitcoiners, we certainly believe that the money printer go burr can definitely lead to inflation and that it is what caused the inflation we just experienced. It can definitely cause asset bubbles and speculative frenzies as some of that extra money starts to flow into specific markets. You, for example, have probably heard about Max Kaiser railing about the quote-unquote zombie corporations, which are big businesses that have been around for years without really any business model, and they really only exist because they keep doing funding rounds, taking more venture capital investment, but they've never released a product in many cases, let alone turned a profit. And that's the sort of thing that happens when money is cheap and easy. So, the Dutch Republic in the 1630s, they didn't have a modern central banking system. The economy relied on a mix of gold and silver coins like the florin, bills of exchange, and some early forms of credit through institutions like the Bank of Amsterdam, which was founded a few years earlier in 1609. While the Bank of Amsterdam helped stabilize currency by standardizing coin values, it didn't engage in modern monetary policy like quantitative easing. So, a quote, increase in money supply in the 1630s more likely would refer to an influx of the precious metal coins from trade and conquest, think of the Dutch East India Company, growth in credit availability, of course, and an increase in the velocity of money, which is how quickly money changes hands once it's moving around in the economy. During Tulip Mania, the tulip trade involved extensive credit relationships with forward contracts similar to futures. Spectators often bought bulbs on credit, promising to pay at a later date. Supply constraints and contractual obligations exacerbated this. Kind of think of the GameStop squeeze. There was there were contracts out for more GameStop shares than there were GameStop shares in existence. So when Roaring Kitty and his apes started refusing to sell any when they started stacking GameStop stock, the companies, the hedge funds that had taken out these huge synthetic short positions were really in a world of hurt, and that why they had that gigantic short squeeze. And that this is kind of a similar concept in many ways. Luke Broyles' post focuses on the broader decline of the Dutch Empire, which he attributes to the demonetization of their spice trade, kind of getting so successful that they collapsed their own economy in many ways. The Dutch East India Company had a near total monopoly on spices like nutmeg and cloves for over 150 years. However, by over-regulating and flooding the market with spices, they eroded the value of their own trade goods, a process Broyles calls demonetization. This led to a feedback loop: declining profits, cultural decay, and an explosion of debt that could not be refinanced when the demand for Dutch debt dried up. The charts in Broyles' post show collapsing stock prices, skyrocketing bond yields, and falling spice prices, or annuities, starting around the late 17th century with significant turmoil during the 1670s and 1780s during the Fourth Anglo-Dutch War. But getting back to Always Learning's question, Tulip Mania occurred earlier, in the 1630s, during the Dutch Golden Age, and as such, credit expansion certainly played a critical role. Speculators used these forward contracts to buy tulip bulbs, often with little upfront payment at all, betting that they could flip them when the price increased in the future. Kind of sound like the housing market in 2008 much? This created a leverage effect where small amounts of money controlled large positions, amplifying both gains and losses. Again, the Dutch economy in the 1630s was booming, with more wealth pouring into the country from overseas from their trade. This prosperity likely increased the velocity of money. People were willing to spend and speculate more freely. And while Tulip Mania itself didn't directly cause the Dutch Empire's collapse, it reflected early signs of the economic vulnerabilities that Broyles describes. The speculative frenzy showed how quickly capital could be misallocated in the Dutch economy, and, well, as an example for all economies, driven by greed and overconfidence, mirroring Broyles' point about cultural decline. A society overly focused on short-term gains, whether tulips or spices, might neglect sustainable growth. Then there was the cultural shock from Tulip Mania's crash, probably further eroding trust in the financial systems. So in summary, an increasing money supply, and especially in terms of easy credit, definitely played a role in amplifying the bubble. The same dynamic indirectly connects to the Dutch Empire's later collapse by highlighting the early financial vulnerabilities, over speculation, credit dependence, and value erosion that became fatal over time. And in that context, Tulip Mania can be seen as a precursor to the economic patterns that eventually caused the collapse of the Dutch Empire. Of course, as the late night infomercials always proclaim, but wait, there's more. And of course, almost everything the average person knows about the tulip bubble is wrong. In September 2017, Smithsonian Magazine published an article titled, "There Never Was a Real Tulip Fever." And although this article was published in the early part of Bitcoin's euphoric run-up to $20,000 later that year, It wasn't written about Bitcoin. It was inspired by a movie that had just come out that month called Tulip Fever. And the article begins, when tulips came to the Netherlands, all the world went mad. A sailor who mistook a rare tulip bulb for an onion and ate it with his herring sandwich was charged with a felony and thrown in prison. A bulb named Semper Augustus, notable for its flame-like white and red petals, sold for more than the cost of a mansion in a fashionable Amsterdam neighborhood, complete with coach and garden. As the tulip market grew, speculation exploded, with traders offering exorbitant prices for bulbs that had yet to flower. And then, as any financial bubble will do, the tulip market imploded, sending traders of all incomes into ruin. For decades, economists have pointed to the 17th century tulip mania as a warning about the perils of the free market. Writers and historians have reveled in the absurdity of the event. The incident even provides the backdrop for the new film Tulip Fever, based on a novel of the same name by Deborah McGough. The only problem? None of these stories are true. The article delves into the history of tulips and how they came to find their way into Dutch society, etc., before they finally get back to the heart of the matter a few paragraphs down. Continuing on, the article says, according to popular legend, the tulip craze took hold of all levels of Dutch society in the early 1630s. Quote, the rage among the Dutch to possess them was so great that the ordinary industry of the country was neglected, and the population, even to its lowest dregs, embarked in the tulip trade, wrote Scottish journalist Charles Mackay in his popular 1841 work, Extraordinary Popular Delusions and the Madness of Crowds. According to this narrative, everyone from the wealthiest merchants to the poorest chimney sweeps jumped into the tulip fray, buying bulbs at high prices and selling them for even more. Companies were formed just to deal with the tulip trade, which reached a fever pitch in late 1636. But by February 1637, the bottom fell out of the market. More and more people defaulted on their agreement to buy the tulip bulbs at the prices they'd promised, and the traders who had already made their payments were left in debt or bankrupted. At least that's what has always been claimed. In fact, quote, there weren't that many people involved and the economic repercussions were pretty minor, Golgar says. I couldn't find anybody that went bankrupt. If there had been a really wholesale destruction of the economy, as the myths suggest, that would have been a much harder thing to face. That's not to say that everything about the story is wrong. Merchants really did engage in a frantic tulip trade, and they paid incredibly high prices for some bulbs. And when a number of buyers announced they couldn't pay the high prices previously agreed upon, the market did fall apart and cause a small crisis, but only because it undermined social expectations. Quote, in this case, it was very difficult to deal with the fact that almost all of your relationships are based on trust. And people said, quote, I don't care that I said I'm going to buy this thing. I don't want it anymore, and I'm not going to pay for it, end quote. There was really no mechanism to make people pay because the courts were unwilling to get involved, Goldgar says. But the trade didn't affect all levels of society, and it did not cause the collapse of industry in Amsterdam and elsewhere. Article continues on, and then a bit further down it concludes with, so if tulip mania wasn't actually a calamity, why was it made out to be one? We have tetchy Christian moralists to blame for that. With great wealth comes great social anxiety, or as historian Simon Schama writes, in the embarrassment of riches and interpretation of Dutch culture in the Golden Age, quote, the prodigious quality of their success went to their heads, but it also made them a bit queasy. All the outlandish stories of economic ruin, of an innocent sailor thrown in prison for eating a tulip bulb, of chimney sweeps wading into the markets in hopes of striking it rich, those come from propaganda pamphlets published by Dutch Calvinists, worried that the tulip-propelled consumerism boom would lead to societal decay. Their insistence that such great wealth was ungodly has even stayed with us to this day. Some of the stuff hasn't lasted, like the idea that God punishes people who are overreaching by causing them to have the plague. That's one of the things that people said in the 1630s, Golgar says. But the idea that you get punished if you overreach, well, you still hear that. It's all pride goes before the fall. So that wraps up the article. So in conclusion, the tulip mania was clearly a speculative bubble, and it was influenced by cheap and easy money and high time preference. But most likely what you've heard about the past was bullshit. It was just a typical cycle fueled by greed, FOMO, and speculation, but most importantly by the fact that credit was available to people who probably shouldn't have had it. All right. That was a fun little distraction, but we do have a lot of interesting Bitcoin news to talk about today, so we'll get right into that. But before we do, we'll take our customary look at Bitcoin's vital statistics. At the time of this recording, we are at block height 893,697, and Bitcoin is ringing in at 93,770 US dollars, almost 10,000 US dollars higher than last DCA Wednesday. Unfortunately, that means that each dollar that we convert into Bitcoin today will only purchase 1,066 Satoshis per dollar. As we cross past $100,000 per Bitcoin again, then we will receive less than 1,000 sats per dollar. And that's one of those, that's that catch-22 thing. Every time the price of Bitcoin pumps, I'm torn. I'm very excited. And I think it's only human to look at your Bitcoin stash and immediately see the fiat value, because we live in a society that denominates prices in fiat still. But then, just like I mentioned, you look at the number of Satoshis you're going to get, and you start thinking about the size of the stack that you dream about having one day, maybe, and realizing that it's going to get harder to happen if it happens at all. And of course, all of the people that are no coiners in far-flung reaches of the world where they might not even know a Bitcoiner, that means it's going to be even harder for them to get into the Bitcoin economy than it has been. But that's just the nature of the beast. And actually, we're going to talk a little bit more about that when I review a specific news story coming up. So I don't want to get ahead of myself. Bitcoin's current price gives it a market capitalization of $1.86 trillion, again, making it the sixth most valuable asset in the world. Pretty cool. Still below that $2 trillion mark. But I think we just recently passed Google today, and up almost 0.2 trillion, almost 200 billion over last DCA Wednesday. For those of you who continue to value your wealth in shiny yellow rocks, maybe you're excited that gold is setting new all-time highs. It will currently cost you 28.1 ounces of gold to purchase just one Bitcoin. That is almost a full extra 3 ounces of gold over last DCA Wednesday, even with the price of gold setting all-time highs. It just goes to show what I spoke about, I think, in quite a bit of detail last DCA Wednesday, and I know in a couple previous podcasts we spoke about how gold really isn't that rare, and that as demand for gold goes up, the amount of time and resources that companies are willing to spend to extract gold, it increases. There's more incentive to mine, so more gold gets brought on the market. And then we talked about the asteroids, that there's an experimental probe being sent to one of them as we speak to try and discover how easy it is for them to mine that gold and bring it back to Earth. Last DCA Wednesday, we spoke about potentially even using fungus or mycelium in that endeavor. But the point being, there will never be more than 21 million Bitcoin, and as such, everything will trend to zero in terms of Bitcoin, even with gold pumping right now. And I've also said this many times, when you have epic inflation, when you have runaway inflation, the cost of everything goes up. It isn't just your eggs or houses, it's everything, because the value of the fiat that you're spending is decreased. And so it takes more of it to purchase everything. And that includes gold. So in fact, that was before Bitcoin was discovered, before absolute scarcity was discovered, absolute digital scarcity was discovered. That was gold's claim to fame, that it was a store of value, that it would hold its value. And I related the story from it wasn't Shift Gold, but it was Roslyn Gold, or one of the gold companies, where they had the commercial that would say, during Roman times, a gold coin would buy you a nice toga, a belt, and a pair of sandals. At the time of the Federal Reserve in the early 1900s, one gold coin would buy you a nice suit, a belt, and a pair of shoes. And even at $3,500 an ounce, or whatever the price of gold is right now, it will still just buy you a decent suit, a pair of shoes, and a belt. So that's its claim to fame, that it keeps track of inflation. And basically it does that not just because it's scarce, but because it's a commodity. And so people celebrating that the price of gold has climbed, congratulations, you preserved some of your wealth, but you're not making a killing. You literally have the same purchasing power that you did a couple years ago. In fact, when you zoom out even just a little bit, basically they've only 10x'd the value of gold since the 1990s to get where they're at now. And inflation has been more than 10x over the last 30 years. So it hasn't even really held It hasn't even really held its value against inflation. And that is because, as I said, when the price of Bitcoin goes up, companies like Barrick Gold and what used to be Homestake Mining and all these little mom and pop miners, they start working harder to extract that gold. Maybe they go back and reprocess old tailing fields at abandoned mines that they threw away that had traces of gold in them, but not enough to make it worth their while. And as the price goes up, they go back, reprocess that ore. They go explore for new mining sites, and they even talk about extracting gold from seawater, because I forget what the figure is, but there's so much gold absorbed in just an acre of seawater that basically it would double the amount of gold that's ever been extracted if we could find a way to do that efficiently. So that's all I'm going to say about gold. I think you get the point. If you're a Bitcoiner, I'm sure you already agree with me. If you've just listened to the podcast for the first time, a lot of Bitcoiners were gold bugs first. That's why some of the original cryptocurrency projects were like BitGold, when they were before Bitcoin was discovered, when they were trying to come up with a fair, stable currency, a private currency, etc. But again, I'm getting off on a tangent. For those of you who value your wealth in pizza, one Bitcoin will currently purchase you 5,244 large pepperoni pizzas from Papa John's. That is one pizza every day for almost 14 and a half years, which works out to almost a year and a half more worth of pizza than just last DCA Wednesday. Certainly a heck of a lot more pizza for the Satoshi than Laszlo got all those years ago in May of 2010 on that very first Bitcoin Pizza Day, when he made the first real world purchase with Bitcoin and purchased 2 Papa John's pizzas for a whopping 10,000 Bitcoin. But again, I'm getting off on a little bit of a tangent. The point being, everything trends to zero in Bitcoin terms, including pizza. All right, that metric that has been my favorite for most of the history of this podcast, Bitcoin's 24-hour average transaction rate, is ringing in at a respectable 4.9 transactions per second. There's been a little bit of shakeup in this statistic, because back in the day, 4 years ago, when we first started talking about this, anytime we saw more than 3.14, 3.15, or 3.25 transactions per second, that was impressive on-chain activity, and it usually meant that we were in a bull run, or it has corresponded with being in a bull run. That correlation isn't causation, but that had been the history for the entire history of this podcast, at least since I've just been casually observing that statistic. Then we had Taproot, and we had the ordinals, the inscriptions, the BR20 token spam, etc. And then it wasn't unusual to have, almost 9 transactions per second on chain, 8.5, pushing 9 transactions per second. And even, most of that was that spam. It wasn't actually on chain activity. So it kind of masked how many real Bitcoin transactions were out there changing hands amongst plebs. But recently, as Bitcoin pulled back in the last couple months and scams and things fade, the pump and dumps only last for so long, kind of like the Tulip Mania, which was certainly a pump and a dump. We've started to see those transaction volumes trend back to where if we see above 3.5 or 4 transactions per second, things are usually really humming, and that is certainly the case today. Speaking of that on-chain activity, the Bitcoin mempools are more than twice as full as they were last Wednesday. Clark Moody's dashboard is showing 29,204 transactions in their mempool, up from 14,204 last Wednesday. Similar story at mempool.space. They're showing 29,284 today versus 14,201 last DCA Wednesday. Still nowhere near as crazy as when there were more than 100,000, almost over 200,000 transactions, I believe. Yeah, all the way back in October, there were 228,931 pending transactions, kind of at the peak of all that spam. So certainly not incredibly bloated, not jam-packed, not the worst we've seen, but a lot more activity than just the last 2 weeks. The previous episode, I mentioned there were only 14,000 or so. Before that, there were only 2,200, and then only 1,800 3 weeks ago. So activity's certainly heating up. And because activity's heating up, it's going to be a little more expensive to make an on-chain transaction. And this is kind of misleading. I'm looking at 2 different sources, and Clark Moody's dashboard, their fee estimator is saying that if you have a priority transaction that you need to be in the next block, Then it's going to take a fee of 20 sats per VByte to do so, up from 3 last week. I think that's a little misleading because right before I saw this last block it mined, it had been quite a while since the previous block, and so fees have been ratcheting up, and now fees are starting. I think fees are starting to trend down. That was kind of an anomaly, but if you do have an on-chain transaction and you want to lowball that fee, make sure that you've gotten this data from a source or sources that you trust, and that you also use replace by fee, or you're familiar with child pays for parent, or the transaction accelerator on mempool.space. So you don't end up with a transaction that gets stuck and never confirmed, just in case we're on the edge of the bull run taking off again and fees spike. And that will happen sooner rather than later. Clark Moody's fee estimator is saying that a fee of just 1 sat per VByte will still be confirmed within 24 hours. So take that with a grain of salt. Mempool.space is saying a slightly different story. They're saying that a fee of just 3 sats per VByte will still get confirmed in the next block. That works out to just 39 cents in US dollar terms. And that's actually cheaper than last week when they were recommending a fee of 4 sats per VByte for a high priority transaction. They are saying that if you have a medium or low priority transaction, you should still include that 3 sat per VByte fee. And the lowest they'd recommend is 2 sats per VByte for a very low or no priority transaction. Since the last Bitcoin Bulletin podcast, we have had a difficulty adjustment in the difficulty that it takes to mine the next block of Bitcoin, and that was an upward difficulty adjustment of 1.4%. Not quite as big as it was looking like. Last DCA Wednesday, it was looking like it might be up to a 4% difficulty adjustment. So things slowed down and got more realistic, and that is why we wait that full 2016 blocks before Bitcoin Core decides how to adjust the Bitcoin mining difficulty. And we just had that difficulty increase, so we're still about 10 days away. Looks like the next difficulty adjustment will be on May 3rd, 1,407 blocks from now. And it's too early to tell. Just like even last week when we were only a couple of days away, we were looking like we were going to have maybe a 4% increase, and we only had a 1% increase because things can happen. And blocks are found really on random chance. Anyway, that's kind of like if you're flipping a quarter. You might flip a quarter and get heads 4 times in a row, but if you flip that quarter 2016 times, you should have 1,008 heads and 1,008 tails or so. Same thing with difficulty adjustment, and that's why it was prudent to wait. Either way, depending on where you get your data, it's saying it's going to be a decrease, and it's a wide range, anywhere from -2% to -8%. Again, I wouldn't try and place any bets on that, because in general, the history of Bitcoin is that just like the price goes up and to the right, so does the hash power securing the network. So ultimately, it's going to be increases forever, Laura, forever. If you just zoom out. But from time to time, things happen that cause a reduction in hash rate or an increase in hash rate that's a little more than usual. So I guess we'll just have to wait and see. Again, it's only really important if you're a miner, because if you're a pleb and you're making a transaction, even if blocks are coming in a minute slower than they should or a minute faster than they should, that doesn't mean the next block's going to come in a minute slower or a minute faster. It could be a minute away, or it could be at half an hour away, or a couple weeks ago, a couple episodes ago, we were looking at a block that had taken almost an hour and a half to come in at the previous block. So again, basically random chance. But that is why we have the difficulty adjustment every 2016 blocks instead of on the fly like some other altcoins have tried. And the reason why the current estimate is going to be that a difficulty increase or decrease, a potentially significant one, is because, well, in the first 3 days since this difficulty adjustment, blocks have been averaging 10 minutes and 55 seconds, obviously significantly slower than 10 minutes. And so if that keeps up, the difficulty be decreased to try and speed those blocks up. Likewise, if blocks come in super fast and we dip below 10 minutes, then the difficulty will increase to try and slow them down. The point is, the Bitcoin protocol tries to keep blocks averaging 10 minutes between blocks. Real quick, I want to thank those of you listening on your favorite Podcasting 2.0 apps, such as Fountain. Podcasting 2.0 allows you to contribute value back to this podcast by either streaming sats on a minute-by-minute basis as you listen, or by sending a boost, which is a shout-out via a Lightning transaction. But because it is a Lightning transaction, in addition to getting to say hi or say whatever you want, you are also sending value back in the form of Satoshis. And of course, when we do receive boosts, we read them on the next episode of the Bitcoin Bulletin Podcast. And speaking of you, the listener, our geographic distribution of listeners had a tiny change last DCA Wednesday, but it is exactly the same today. The top 10 countries where our listeners are located is as follows. Number 1 is the United States of America, where more than half of you are listening. So hello to all my fellow Americans. Thank you for taking the time to listen to this podcast. Number 2 remains Singapore. So apa kabar? Thank you to all of you listening in such numbers that you're the second largest country where our second largest number of listeners to this podcast are in Singapore. I have got something going on outside the studio that's starting to get me a little bit distracted, so I apologize if I jumble up a bit. It's also been a heck of a week. There's a pretty bad flu bug tearing through the family, and a couple other family members are sick, and there's some other things that are going on, so I apologize if I seem a little frazzled. I'm trying to focus straight ahead on my notes and this microphone. But once again, thank you to those of you listening in Singapore in such numbers that you remain the number 2 country in our top 10. Number 3 remains Germany. So, Dankeschön, mein Freunds in Deutschland, or I guess I was going to say Guten Abend, but depending where you are, it's probably getting close to Guten Morgen. But either way, thank you for listening in numbers sufficient that you've retained that number 3 spot for months, if not years. Number 4 remains Argentina. So, hola, muchas gracias, amigos in Argentina. Number 5 remains Luxembourg. So, Dankeschön, mein Freunds in Luxembourg, or Morgen, to those of you speaking Luxembourgish. Number 6 remains Canada. I was listening to the Canadian Bitcoiners podcast the other day, and it sounds like weather took a little bit of a turn for the worse, even though it had been starting to warm up and get a little bit nicer. But thank you to those of you listening north of us up in Canada. Number 7 remains the United Kingdom. So hello and thank you to our cousins across the pond. Number 8 remains Spain. So hola, muchos gracias, amigos in Spain. Number 9 remains Australia. So hello and thank you to those of you down under. And number 10 remains Mexico. So hola, muchas gracias, amigos en Mexico. All right, on to the news. One of these days, we're going to have an episode where the price isn't the thing that everybody is talking about. That there's some other news that isn't like the biggest news that's just dominating. I've been dominating for the whole week. But alas, once again, price tends to dominate the news. And of course, we're booming again. I mean, we're not at all-time highs, but Bitcoin was only over 100,000 for a handful of days. So being back above $90,000, 93, 94,000, I think we hit almost $95,000 earlier today. It was pretty significant. I've mentioned repeatedly that in the previous halving cycle bull runs, there have been 5 to 7, 30% pullbacks all the way up, all the way up to the new all-time high before they finally have that blow off top, which usually happens about 18 months after the halving. So we had the all-time high in 2017, in December 2017, and then we had the next all-time high in 2021. Of course, there was another one which was unusual after the ETFs were approved. We got a pre-halving pump this time, but if history continues to rhyme, we should continue to chug-a-lug along up until maybe late summer, and that's when we should really start to see things take off. Again, nobody has a crystal ball, and history doesn't always repeat, but it has usually rhymed, especially when you're talking about mathematics and human nature, both things that don't tend to change or change at all, if not so at all. Change very often, if not so, if not never. All right, yesterday, Turdemeester retweeted a quote that he thought was possibly explaining why Bitcoin has surged 12% in the last week, retweeting a tweet from Matthew Siegel saying that SoftBank was to join Tether, Bitfinex, and Cantor to launch 21 Capital, which was going to be seeded with $3 billion in Bitcoin and set to go public via SPAC. And then it linked to a pretty lengthy commentary on that. Basically, the long and the short of it is increased institutional adoption. We've got banks getting into Bitcoin, we've got companies getting into Bitcoin, we've got countries getting into Bitcoin, and this is just another example. But we're talking about someone, or in this case, a company, a SPAC, buying $3 billion of the Bitcoin. And that, when we're talking numbers that large, that's really why institutional adoption, corporate adoption, nation-state adoption is really putting this bull run potentially on a whole nother level. There weren't a whole lot of people in the 2017 bull run, dumping $3 billion into Bitcoin. And we still saw the price of Bitcoin 20x in the span of a year. Of course, not everybody is particularly jazzed by this development. Daniel Prince, the host of the Once Bitcoin podcast, tweeted, he retweeted a tweet from TFTC saying the same thing and saying, "We are being co-opted. This is not winning." All right, I get it. A lot of people are concerned about decentralization. And of course, I personally want every Satoshi possible in the hands of as many ordinary plebs as possible. And that is one of the reasons I put out this podcast, not only to encourage grassroots adoption, but also to show that it is still possible. And it's still possible for even those of you who may only have a couple of dollars to convert into Bitcoin at any given time. All of that being said, this was simply inevitable. Bitcoin is for everybody. Satoshi knew it. Hal Finney knew it when he posted about it shortly after Bitcoin launched, about the Bitcoin maybe hitting $10 million a Bitcoin one day when we start seeing mass adoption. And fortunately, all of this was also taken into account by the genius of Satoshi Nakamoto. Part of the genius of the issuance schedule and the halving is that Bitcoin's issuance was highly biased towards the early adopters. So, it made sure that the majority of Bitcoin was rewarded well before we got to this point, well before the greedy fat cats on Wall Street started seeing that this might be an opportunity to make a buck, well before, geopolitical issues came into play. Companies started talking about Bitcoin as a strategic reserve asset. Remember, there's only ever going to be 21 million Bitcoin, and almost 20 million of them have already been issued. More than 94% of the supply that will ever exist has already been rewarded. So the only way companies and countries will be able to stack a significant number of sats is if you sell it to them. And they're going to have to pay an ever higher price in fiat terms to coax those sats out of people's wallets. Well, that and FUD. That's why they try to FUD the market down from time to time to shake out Bitcoin from newbies and weekends to try and pick up some cheaper sats. But once again, I digress. The whole point is stay humble, stack sats, and we'll be fine. It doesn't matter how much Bitcoin Wall Street has, how much Bitcoin Michael Saylor has, how much Bitcoin El Salvador, the United States has. It doesn't influence code. They don't make any decisions, on BIPs or on, they have no say whatsoever. All they really do is they get to hold. It's not like proof of stake, like Ethereum, where your influence on validating a transaction is directly related to how much Bitcoin you have. Proof of work was a genius invention. And that's the other reason that, a couple of years ago, they were really, really trying to FUD that whole change the code thing to get Bitcoin to get rid of proof of work, because that was really, I think, the last gasp of Wall Street and of corporate interests trying to destroy Bitcoin. They figured the only way they could ever destroy Bitcoin, you can't shut it off. You can't stop people from using it. You can't block transactions. But if they could just convince us, the node runners, to change the software on our nodes, then maybe they could destroy Bitcoin from within. But fortunately, that failed. But once again, I digress. Stay humble and stack sats. But speaking of companies gobbling up the available supply, MicroStrategy apparently has gobbled up another 6,556 Bitcoin. Michael Saylor tweeting out 2 days ago, MicroStrategy acquired 6,656 Bitcoin for $558.8 million at 84,785 per Bitcoin, and has achieved a Bitcoin yield of 12.1% year to date, 2025, yada, yada, yada. The point being, Michael Saylor and MicroStrategy are relentless, and they are going to continue to snap up every Bitcoin they can. And now that pool is starting to get crowded. They're not the only big fish swimming around trying to snap up those Satoshis. So one more company that is now apparently following the Saylor playbook, once again vindicating when I predicted that this would be the cycle that vindicated MicroStrategy. On Sunday, Pete Rizzo, the Bitcoin historian, tweeted, new Brazilian fintech Milius that has invested 10% of cash in Bitcoin tells its shareholders it will buy more. Corporate adoption accelerating. Linking to a corporate press release from Milius, which is in Spanish. So for those of you who are listening from Spanish-speaking countries, maybe you want to follow up on that. But the long and the short of it is, for those of you who don't speak Spanish, the company plans to amend its corporate bylaws to officially include a Bitcoin investment strategy. And they're going to have a shareholder vote scheduled on May 6th. 2025. And the big thing is that this is just, I mean, even with all this happening, we're still early. There's hundreds of large corporations out there that will dive into Bitcoin sooner rather than later. Right now, we only have a handful. They are truly the early adopters. Michael Saylor being the OG. Maybe Elon Musk and Tesla, a handful of other companies, but Michael Saylor being the OG whale from the corporate stackers, the corporate treasury standpoint, anyway. But the point being, it's only going to continue to grow, and corporations currently hold 4% of the Bitcoin supply, which is already mind-blowing. But again, that's just the tip of the iceberg. Just a few small dribbles spilling over the top of the dam that's holding back trillions of dollars of potential fiat demand. And remember, it isn't just companies jumping on the bandwagon in this cycle. This is also the cycle that's going to vindicate El Salvador. It's already vindicating El Salvador as nation-state FOMO continues to build. And then just hours ago, like just 2 hours ago, Pete Rizzo, the Bitcoin historian, also tweeted out, breaking: Russian Central Bank and Finance Ministry announced national Bitcoin and crypto exchange, nation-state FOMO, with a press release or a news article in Russian. But if you want to read more, Turdemeester has a comment right below where he provided a translation of the article in the comments on Pete Rizzo's original post. So all of this, as I keep reminding you, is that we're still early, both in terms of adoption and in terms of this Bitcoin bull run. And when we have, there's only so many countries. There are no other companies that are going to be able to stack what MicroStrategy has. They're already in a league. They already have such a significant head start. If any other country tried to get where they were, it would just soak up the supply. So there would be such a war for every Satoshi, a bidding war for every Satoshi, that the price would go. Those God candles, we'd be talking, $100,000 candles. It would just be nuts. And that will eventually happen. The question is how fast and when. But the point being, there's only ever going to be 21 million Bitcoin. There's only 1 million Bitcoin out there left to be mined. Hopefully you are stacking and making sure you have your piece of the pie when we do have Bitcoin hyper Bitcoinization. All right. That is all the time I have to get into the news. I do need to move along to what makes today an every Wednesday special, and that is that today is DCA Wednesday. For those of you just listening for the first time, DCA Wednesday is when we test out the hypothesis of dollar cost averaging, which is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. I wanted to show that A, you're not too late, and that B, if you're not rich, if you're not a Michael Saylor, even if you only have as little as $20 a week to stack, that you can eventually build a supply of Bitcoin that will secure your family for generations to come. So our equal portion we chose at just $20, and our regular interval we chose weekly on Wednesdays. Both of these are you do you things. I'm not saying that you should invest $20 a week. This is not financial advice. You do your research and you figure out what's appropriate for you. And certainly for many people listening, $20 would seem almost like not even worth your time. But there are people, I guarantee it, listening to this podcast, that would lose sleep over it, over $20. So we chose weekly on Wednesdays, and we chose $20 to try to appeal to as many people as possible, but also to show that even if you're in that boat, just $20 a week will add up over time. And it has. This is going to be our 196th stack. We started the DCA Wednesday series all the way back on Wednesday, July 28th, 2021. And so far we stacked 195 times, and we've done it just $20 a week, but it adds up fast. And we've now converted $3,900 into Bitcoin. And that has built us a stack of more than 0.1 Bitcoin. 10,594,683 sats, and we've done so at an average purchase price of $36,810.92 by stacking consistently as opposed to trying to time the markets and aping all in. And I remind you that even if Bitcoin were distributed completely fairly, if there were no Bitcoin lost, no whales, no multi-coiners, if we took every Bitcoin that will ever exist and divided it by everyone in the world, there'd be less than 150,000 Satoshis per person. And we already have 10,594,000 Satoshis just by stacking only $20 a week. And we're going to grow that stack today. And this is probably the last week or the second to last week we're going to use Cash App to do so. As I mentioned last DCA Wednesday, Cash App is basically doubling their fees. They were already more expensive than a lot of other options. Doubling it is just unheard of. So I'm disappointed. I'll probably be either using Strike or River. I've yet to decide that. But for this last week or two, before the new fees go into effect, we're going to use Cash App. This again is a you do you thing. Cash App is not a sponsor of the show. I just thought they were the easiest way to stack small amounts. If I were going to buy 10,000 or even just 1,000 or even a couple $100 of the Bitcoin, I would have probably bought it from an exchange that charges more like a 0.5%, not 2.25% that Cash App charges. But when we're buying small amounts, it's super quick and easy to use Cash App, and they have some advantages like allowing you to transfer money immediately to Cash App, allowing you to buy Bitcoin right away, and allowing you to transfer it to your hardware wallet immediately. Most other exchanges will make you sit on that Bitcoin before they'll either make you sit on that money before you're allowed to buy Bitcoin, or they'll let you buy Bitcoin, but they won't let you transfer it. And they usually charge you more than what the fair mining fee is to send that Bitcoin. Last time I transferred Bitcoin, I Uncle Jim'd somebody, helped them transfer Bitcoin from their Coinbase account. Really, it should have been about a 25-cent mining fee, and Coinbase charged them $7. It was just obscene. Cash App is going to let us transfer our Bitcoin for free. So I think that's going to make up for the 45 cents in fees that we're paying, even if we could have saved 40 cents by using a different service. But alas, those days are coming to a close. But until then, I have Cash App open. I already have $20 on Cash App. So it's simple as easy as just tapping Bitcoin, tapping buy, entering $20, tapping confirm, and boom, just like that, we've stacked another 20,890 sats for that $20. Still happy that we're getting at least 20,000 sats for those purchases. Once Bitcoin goes north of 100,000 US dollars again, we'll be getting less than 20,000 sats. So again, that's that catch-22 where it's both exciting to see the price of Bitcoin go up and depressing that you're going to get fewer Satoshis for your fiat. But those 20,000 sats have brought our stack up now to a total of 10,615,573 sats. It did increase our average cost price, our average cost basis, our average purchase price by a little more than $115. So our average cost basis is now $36,926.88, getting ready to tilt into $37,000 range, but still less than half of the current US dollar value of Bitcoin. So not too shabby. And perhaps as importantly, it's significantly less than what the Bitcoin's current value is, but who knows what fraction of a price of Bitcoin it'll be by the end of the year. When Bitcoin, for example, reclaims that $100,000 mark, which it could be on the verge of doing, or maybe we have a little bit of consolidation. Who knows? I don't have a crystal ball. But when Bitcoin reclaims 100,000 US dollars, our current stack, without stacking another Satoshi, will have a US dollar fiat value of $10,615.57. A heck of a return, considering we've just now converted $3,920 into Bitcoin. When Bitcoin hits 1 million, which I firmly believe it will do, maybe not this cycle, but maybe next cycle sounds certainly reasonable. Again, no crystal ball. Things could certainly come to pass that make it happen sooner than that, or things could happen that make it take longer, but we're on that trajectory. And when we get there, our current stack, without adding one more Satoshi, will have a US dollar value of $106,155.73. An obscene return for $3,920. The kind of return that only Nancy Pelosi or Hillary Clinton would have gotten in the good old boy system. And of course, Adam Back predicted back in 2022 that by the year 2032, Bitcoin will hit $10 million per coin. If that's true, or when it happens eventually, our current stack could be worth more than $1 million. $1,061,557.37 to be precise. And who could forget Fidelity's Jurrien Timmer, their director of global macro at Fidelity Investments, when he said that they believe that one Bitcoin will be worth $1 billion, billion with a B, by the year 2038. And if that comes true, our current stack will be worth an insane $106,155,730. an impossible to believe, just like it was impossible to believe Bitcoin to hit 20,000 in 2016, but an impossible to believe figure that Bitcoin will surprise everybody with one day, and certainly not too shabby considering that we've converted only 3,920 US dollars to get there. It would definitely put us in the camp of those kids back in 2012 that took their Christmas money or their bar mitzvah money or whatever, and they bought $1,000 worth of Bitcoin and turned that into 100 million. And people thought, wow, that's amazing. They got lucky, and maybe they did. But in our case, we're not going to be lucky. We've been slogging in this podcast. We've been slogging for 4 years now. 4 years now. We bought all the way up to the 2021 high, and we bought all the way down to the low, and we bought all the way back up. And we've held those strong hands, as Adam Meister likes to say. And we keep stacking Wednesday after Wednesday, regardless what the price of Bitcoin is. When people have been making fun of us, when our family members are belittling us often from time to time, talking about tulip mania, etc. One day, when we do hit hyper Bitcoinization, they will be calling us lucky. They'll be jealous, especially the people you tried to orange pill that didn't listen to you. But rest assured, you even right now, if you've been stacking with us for 4 years, raise a glass to yourself, because stacking the last 4 years was stronger, more iron will than most people have had out there. There are plenty of stories about people that ape in and then dump for a loss the first time that the market quakes. And so if that wasn't you, congratulations. And we are just getting started, because like I said millions of times, we are still early. All right, as usual, before I wrap up, if you enjoyed listening to this episode, I would ask that you do me a solid and give it a 5-star review, and also that you share it with a friend or family member who may be interested. That goes a long way towards boosting us in the search results and feeding that algorithm monster. You can also feed that algorithm monster by following us on Twitter or X, where we are at BTC Bulletin Pod. And I know we have a handful of listeners out there that are in fact following us, but we have more listeners than we have followers. So if you haven't taken the time to follow us, please do so. That's the simplest, almost immediate thing you can do that won't cost you anything other than a mouse click to help promote this podcast in the rankings. And maybe just by following us on Twitter, you will help orange pill somebody that maybe thinks they're too late, or maybe thinks, I only have $100. Is it really worth converting it into Bitcoin? You know, they listen to this podcast and see that we're only converting $20 a week. Maybe the person with $500 or $1,000 that thinks they're too late will be like, holy cow, if $20 to do it, then I'll try 1,000, and you'll help orange pill somebody. So of course, I also love hearing from you. So if you do follow us on X, my DMs are open. I have Twitter open right now, X open right now. And if you do DM me, I will get back to you. Of course, if you don't use Twitter, you can also send me a good old-fashioned email. The email for this podcast is bitcoinbulletin@protonmail.com. That's bitcoinbulletin@protonmail.com. I have Proton Mail open, and I do reply to our emails, even if it takes me a day or two to get to my email. If I'm traveling and don't have access to my laptop, I will get back to you eventually. Of course, above and beyond, above it all, don't forget to join us next Wednesday as we continue our Bitcoin journey. But until that time, keep on stacking those sats, you sexy sat stackers.